Julie Biel, portfolio manager at Kayne Anderson Rudnick, joining us. Julie, what do you think? Is this a long-term shift we're witnessing here?
I don't think it's a long-term shift per se, but I do think that the risks are substantial in terms of how that will play into the market. If you look historically, wars tend to be actually pretty positive for equity markets. You see actions happening in terms of defense spending in Germany, for example, and that should actually be a support to underlying economies as they bulk up. But the level of uncertainty means that you don't want to be really positioned in companies that have a lot of cyclical exposure because you don't know how that's going to impact consumer demand, which is, at least here in the US, such a central driver of the economy.
Julie, I'm so glad you mentioned the defense spending bit. Of course, no one really wants to go to war, but from a market point of view, from an equity point of view, it's interesting that during this kind of period, you do have the United States stepping up to make up some of the gaps, especially when it comes to commodity exports. Do you think that could be a bullish driver, not just for the economy, but for the markets?
I think generally speaking, fiscal support, the government support tends to be positive for the economy. We've certainly all benefited, right? But I think longer term, it's sort of a shot of sugar for us in the economy. What really helps the markets longer term, which is kind of our point of view, is good fundamental, solid organic growth. And that is more of a question mark for us because it's not clear whether the consumer demand that we have in this economy can sustain the high levels of pricing, et cetera.
Okay, well, let's take this from a different angle. Julie, how many of the companies that you invest in right now are beneficiaries of globalization?
Oh, I am a small and mid-cap domestic manager, and I would say maybe half are benefits of the global economy and globalization. Many of them are really focused on what's happening in the US. And so maybe they have software development that's happening in different countries, but generally speaking, I have a much greater focus on the US economy than, say, a large cap manager would.
Julie, we've been talking about the Fed all week long. The Fed is certainly a key in the spotlight. Let's talk a little bit about the hiking cycle here. I mean, it's pretty traditional. In the last hiking cycle, you did see equities rise in line with those rate increases. But I'm curious if a steeper hike, for example, means that you're going to see a little bit more of a violent reaction in equities or perhaps even bonds. What's your take?
Well, I think we're kind of in this interesting environment where all of these rate hikes are being extensively telegraphed, right? We have the dot plot. We have most of the members of the Fed regularly talking to the press. I mean, is Bullard going to put out a Pinterest board with his plans for QT? I don't know, right? But, in the dark, gloomy days of Alan Greenspan, we didn't have quite this level of communication in terms of what the next steps were going to be. And we just had to roll up our sleeves and do the work of figuring out how the fundamental economy is going to go. So I think for investors, the real benefit is if you can have a long-term focus and you can build a portfolio such that it can withstand higher rate increases, because we know directionally that's where it's going to go. There's going to be volatility in the near term.
Julie, so just to be clear with what you're saying, and I love the line about the Pinterest board. Would the markets be healthier if the Fed said less at this point?
Yeah, I think so, right? It's a little bit the same thing with companies and their guidance, right? Because we get so dependent on guidance. And the thing about guidance is it forces us to just look at quarter-to-quarter variations. And we're not necessarily really understanding the fundamental health of the business, or in this case, the economy. I think if we had less information, we would look at the data with a longer-term focus in terms of what does this mean for unemployment writ large? How are supply shortages going to ripple through a consumer economy like ours? Rather than next quarter is, 20 basis points, 50 basis points, how does that impact valuations?
Well, let's marry essentially the two major risks that we're talking about. We're talking about a Fed hiking cycle, and we're also talking about the war in Ukraine, which really brings us back to our question of the day. I'm curious about your take on commodity shocks here, because that seems to be the end idea, the idea that demand destruction could plunge the economy and ideally the markets to follow in recession. Ideally is not the quite right word, but essentially you know what I mean. Essentially, demand destruction is the biggest risk here. Do you think that demand destruction can actually have that impact, or is corporate America or the average American citizens actually prepared to weather that shock? What do you think?
It's a question of time, right? I think people right now understand the conflict pretty well, and they understand that higher gas prices are a cost of it. most people are kind of understanding about that, seeing all the violent images that are coming out of Ukraine. But I think longer term, people start to really lose their patience, and especially like higher prices at the pump, that really starts to impact purchasing power, particularly at the low end. What's been great is that most of the wage inflation has actually been happening on lower income consumers, but over time, that just starts to really erode. And so I think there starts to be meaningful demand destruction if this goes on for months and months.
As people look at their portfolios during this period and maybe hope that those portfolios are going to compensate for some of the inflation they're seeing elsewhere, Julie, what kind of rate of return should they be expecting? They're seeing 4, 5, 6, 7, 8% inflation, depending on where you look. Are their portfolios going to match that?
Well, I think it depends how you've structured your portfolio, right? I mean, and it depends too how your portfolio has done over the last 3, 4, 5 years. If you're exposed to high duration tech stocks that have taken it on the chin valuation wise, it's going to be hard for you to get the rate of return that you've been experiencing over the last few years. I think if you're invested in quality businesses, you can expect to earn over a cycle, which is what we try to look at, higher rates of return than you would on government bonds or that sort of thing. I think it's really important to focus on businesses' ability to price, but also businesses' ability to continue to see demand, even if they do price against it.
Julie, talk to us a little bit about that tech bid exactly. You were just mentioning the tech stocks. Obviously, these are quality names. They're also sitting on a ton of cash. I think I was looking at Apple the other day, $200 billion of cash still sitting there. The same issues that kind of hit investors, the idea that you do have cash that is extremely exposed to those inflationary pressures. I think the same applies to the corporate side of it as well. Could that be a downside for tech, that they are sitting on so much cash as opposed to putting it to work?
Yeah, I mean, I think the potential for using that cash has a certain amount of protection. I for sure am not interested in any business that has a lot of leverage. I mean, we never are interested in businesses with a lot of leverage, but generally speaking, in a tightening cycle, for sure. I think the cash is actually interesting in terms of tech companies, in particular, their ability to consolidate their markets, right? You have an FTC that's getting a little bit more robust, a little bit more muscular. So the large cap tech companies are probably actually not going to be able to do that much from an M&A standpoint. But there's a lot of consolidation in the mid and small cap space that could be very compelling. And I think that's where that cash is going to go to work.
Julie, how different is what you're going to do over the next 5 years compared with what you've done over the last 5 years?
It's not. It's genuinely not, because I think we at Kayne really believe that you can't predict, right? Is there anything that we've learned over the last 2, 3 years of this pandemic and this war is like, you can't predict, so you have to prepare. And I think what we try to do is structure a portfolio that can withstand shocks like this, but that still has the opportunity to do well in good times, that has leverage to a better strengthening economy. And so those are just great businesses that you would want to own forever. Close your eyes. They're great businesses that you want to own.